Welcome back. In part one, we learned that Marubeni's $305.5 billion net profit was structurally unbalanced. Today, we figure out why. That headline number was inflated by approximately or $86.0 billion in positive one-time factors, primarily a massive $76.0 billion valuation gain from selling assets. When you strip that away, Marubeni's actual core earnings, their adjusted net profit, only saw a minor decrease of $4.0 billion. This shift is the heart of the analysis. Is Marubeni selling assets to survive, or is it strategically pivoting toward a high ROIC future? We will dive into the strategic platform businesses and their high-growth targets, like the aviation aftermarket business forecasted for 35% CAGR. We'll also analyze the conservative $510.0 billion forecast, which includes a $30.0 billion contingency cushion and the massive upside provided by current $11,000 ton copper prices. This is the information you need to build your decision framework. So let's analyze the quality of the profit and define the risk-reward equation. We have to start with that phenomenal surface number, $305.5 billion in net profit for the first half. That's up a robust 28% year-on-year.
Right, and they've already hit 60% of their full-year target.
It just reads like a complete unmitigated success. But the problem is, that success seems to be coming more from the finance department than from the core business operations, isn't that right?
That is precisely the critical point. They executed some brilliant strategic financial maneuvers, which is why that headline number looks so good. But when you look at the underlying operational health, the actual business of trading and running assets, their actual operating profit, well, it fell.
By how much?
By a steep 13%.
Wow, a 13% drop in operating profit is. That's a serious structural concern. So if the engine is slowing down that much, why now? Why choose this moment to start selling off major assets?
Well, it looks like a genuine strategic renovation, but you're right. The operational pressure is very real. The drop was mainly due to lower prices in their legacy commodity sectors and just the rising cost of doing business.
But I saw revenue was up.
It was, yeah. Total revenue increased 8% to $4.2 trillion, driven by strong movements in metals, minerals, and food. But the key metric, gross trading profit, which is the real measure of their margin health, that actually declined.
Because of those weaker commodity prices.
Exactly. That, combined with increasing SG&A expenses, is what led to the lower operating profit.
So these non-operational strategic gains effectively masked a pretty difficult operating environment. Management seems utterly confident, though.
They do, because they're pushing this narrative that they're actively transitioning away from these volatile areas, moving toward high-growth, high-return businesses.
And we have to test that narrative. To do that, we need to understand the precise value of those strategic gains. You said the headline profit was inflated by about $86.0 billion in these one-time factors.
That's right.
So let's focus on the biggest single chunk of that, the $56 billion valuation gain. I mean, that is massive, and it's definitely not repeatable.
It's not operational revenue at all. The largest piece, about $76.0 billion net of tax, was a non-cash accounting gain.
A non-cash gain. Can you break that down for us?
In simple terms, they essentially reorganized their domestic real estate business, integrating it with Dai-ichi Life Holdings. This move triggered an enormous one-off valuation bump on their balance sheet. It's profit, sure, but it didn't come from selling steel or copper.
Just from moving assets around, basically. What else contributed to that $86 billion figure?
We also saw about $11.0 billion from the sale of their North American railcar leasing business, which is a much more straightforward divestment.
Okay.
Plus, there was an $8.0 billion gain from something called negative goodwill, which was related to acquiring a new electronic components business.
So once you strip all those specific one-time events out, the financial picture becomes much clearer.
Exactly, and that's the reality check for anyone assessing the quality of their earnings. The adjusted net profit, what they call core earnings, was $220.0 billion.
Which, as you mentioned, is only a minor decrease of $4.0 billion year on year. They're calling that resilience. But isn't a $4 billion drop in core earnings still, a bit disappointing?
In this environment, I'd say a marginal decrease is basically a win. And the breakdown really shows why they have confidence. Their non-resources businesses were incredibly strong.
Oh, interesting.
They delivered an adjusted net profit of $163.0 billion. That's an increase of $5.0 billion year on year.
So the entire drag came from the resources side.
The entire $4 billion drop and then some. Resources were down $11.0 billion year on year. So you can see the strategic pivot is clearly working on the growth side, even if it hasn't fully offset the drag of those legacy businesses just yet.
Okay, so non-resources provide the stability, and these strategic platform businesses, the SPBs, They must be the key to hitting that ambitious, high ROIC target. Let's look at those platforms. That's where the future is.
Absolutely. The 6 core strategic platform businesses are the entire rationale for this asset replacement strategy, and they are already generating some serious momentum. Collectively, they posted 65.2 billion in net profit for the first half. That's an increase of nearly 9 billion yen year on year.
All right, let's get into them. Let's start with the one that feels most stable and profitable right now. Mobility in North America. We're talking Now Lake and Wheels.
Yeah, that segment is it's firing on all cylinders. They hit a Q1, Q2 profit of 21.8 billion, which is a solid 5 billion increase.
And management's confident.
So confident, they revised the full-year forecast upward. And this growth isn't accidental. It's fueled by a really smart strategic shift toward higher credit tier customers. They're prioritizing quality and predictable returns.
And the growth rate they're projecting.
A compound annual growth rate, or CAGR, of 22% in yen terms.
Very impressive. But the real high flyer, the one that makes the headlines, has to be the aviation aftermarket and asset trading business.
Oh, absolutely. That platform posted a huge profit increase, up 2.8 billion to 8.6 billion. They raised the full-year forecast for that one, too.
And the CAGR on that is?
An astonishing 35% in yen terms.
A 35% CAGR is an eye-popping target. What is driving that kind of demand in the aviation aftermarket? Are we talking about supply chain bottlenecks or just massive global fleet renewal?
It's both, really. We're seeing huge global demand for aircraft parts that's just exceeding all expectations. Airlines and lessors, they're extending the life of their current aircraft while they wait for new deliveries.
Which fuels demand for maintenance and parts.
Exactly. It's a structural boom.
And to round out the platform's strengths, IT solutions also look strong, I believe.
Correct. The IT and digital solutions business is performing really strongly and is expected to grow its annual profit by 40%. The pattern is just undeniable. These non-resource, high-tech, and specialized service sectors are the foundation of their high-quality future.
So we've seen the impressive future with these 35% growth targets. Now let's ground ourselves in reality. Where are the legacy businesses actually bleeding the capital they're trying to replace?
Yeah.
We have to look at that resources segment again, down 11.0 billion.
Right. The pain was really concentrated in sectors that are exposed to slumping industrial demand. Australian steelmaking coal and the Australian iron ore project, Roy Hill, both saw significant profit decreases.
And what's the outlook there?
Management is correctly cautious. They're predicting that demand from China for steelmaking coal and iron ore will remain structurally weak in the second half.
And energy and chemicals had a particularly brutal period, didn't they? There was a big write-off.
They suffered a severe profit decrease. This included an approximate 11.0 billion impairment loss on their oil and gas E&P assets.
And for listeners, an impairment loss is basically the company admitting an asset on their books is worth less than they originally thought.
Exactly. And on top of that, they saw a decreased trading profit from petrochemical products. It just shows that even with these strategic sales, the legacy resource portfolio requires constant, careful management and carries a lot of volatility risk.
However, there is one resource bright spot that offers huge leverage and acts as a fantastic hidden buffer. That's the copper story.
Absolutely. The Chilean copper mining business saw a solid profit increase of 14.4 billion. What's so fascinating here is that the full-year forecast for resources was actually revised upward by 4.0 billion.
And that's almost entirely due to copper.
Almost entirely due to higher copper commodity price assumptions. Copper is the single best bet they have in that segment right now.
And the upside leeway is massive because current copper prices are far above what management built into their forecast. It's literally the wiring for the AI and data center boom.
Precisely. Current copper prices are hovering around, $11,000 per ton? That's significantly above the $9,900 per ton assumption management built into their second half forecast.
That gap is huge.
It is, and it's all driven by that structural demand from AI, data centers, renewable energy transmission.
Yeah.
That gap between the current market price and their internal number offers a very substantial built-in safety buffer and potential upside that could easily push their results past guidance.
Okay, so all these strategic sales and the profits from the high-growth platforms, this must be doing something huge for their financial footing. Are we seeing real strength on the balance sheet or just a temporary fix from the asset sales?
No, we're seeing real, measurable strength. The cash from these sales went straight to strengthening the balance sheet. Equity attributable to shareholders increased substantially by nearly 250 billion yen.
250 billion. Wow.
Which has improved their key solvency ratios. The equity ratio is up to 41.7%, and the net debt-to-equity ratio improved slightly to 0.53 times.
That signals stability and, I guess, optionality for future investment in those high-growth SPBs. What about their overall cash generation for the year?
The core operating cash flow forecast is robust, maintained at 550.0 billion. And crucially, their divestment target was revised upward by 20.0 billion to 250.0 billion.
So they're accelerating the asset replacement.
They are. And when you combine the operating cash flow and the divestments, the total projected cash inflow is set to reach 800.0 billion. For context, that is the company's second highest level on record.
Generating cash at that level makes their commitment to returning capital to shareholders incredibly credible.
It does. They remain committed to a progressive dividend policy, maintaining the forecast at 100 and more over per share. On top of that, a 40.0 billion share buyback program for the next fiscal year is already in progress.
So they're signaling very clearly that they'll return capital while this whole pivot is underway.
Without a doubt.
Let's rack this up with the guidance. Management have a firm net profit forecast of 510 billion and an adjusted net profit forecast of 460 billion. Given all the volatility we've just discussed, how confident should we be in those numbers?
Well, what's fascinating is the deliberate conservatism in that guidance. I mean, it's really baked in.
How so?
The forecast includes a crucial 30 billion downside buffer. It's explicitly designed to cover potential macroeconomic uncertainties, particularly anything coming from the U.S. economy.
So that 30 billion buffer is essentially an insurance policy they built right into the forecast.
Yeah.
They're telling us, we expect things to get rough, but we have capital ready to absorb the shock before we miss our target.
That's a perfect way to put it.
That cushion is great, but where is the major potential upside if the global economy holds up and those strategic platforms over-deliver?
It comes back to leverage and market conditions. For copper alone, they see a potential 1.5 billion gain for every $100 per ton increase above their conservative assumption.
And what about currency?
On the currency side, they gain roughly 1.6 billion for each 1 yen movement above their forecast USD-JPY exchange rate. So the clear structural shift provides the base, and the strategic gains have strengthened the foundation, providing this high operating leverage to any positive commodity movements.
So what does this all mean? For long-term investors focused on quality and capital returns, ongoing macroeconomic challenges may actually present attractive accumulation opportunities. It offers the potential for significant future returns if the company executes this pivot toward high ROIC, high-growth businesses as planned.
And a final but an important reminder, we are not certified financial advisors, and this content is only for educational purposes. If you are considering making any investment decisions, please consult a certified financial advisor.